Retirement is something we all have to deal with at some point. Wouldn't it be nice to be able to retire a little bit earlier while you're a little bit younger so you can do the things that you want to do and have location freedom, time freedom, and ultimately financial freedom? Well, what is the magic number? The thing is, with trading and investing, there's really no magic number, but it seems to be the consensus is about 100K or 200K to really take advantage of being able to retire and live a decent life. You can actually retire on $100,000. I can tell you that if you start in your 20s, $1,000 a month over the course of a year is $12,000. If you do that over 5 to 7 years, you're pretty close to $100,000. So by 30, 35, you are ready to go. If you start later, 30, 35, or 40, you'll need to put a little bit more money away, like $2,000 to $3,000 a month or more. If you have a really good job, which most likely you do, then you'll be able to do that. If you don't have a great job, then it's going to be a little bit harder. But in this video, ultimately, you can retire on $100,000 just by selling puts. Now, before we move on in today's video, I have a huge announcement. I am hosting a free webinar this Friday, August 16th, 7 p.m. Eastern Time, 4 p.m. Pacific. If you guys want to learn technical analysis, fundamentals, financials, how to read candlesticks and charting, and strategies like selling puts to print juicy premiums, you guys don't want to miss out on the webinar this Friday. Absolutely free, limited spots are available, so you need to register right away before the spots fill up. I will be making a huge announcement during the webinar, and I'll be hosting a Q&A answering your questions. You guys don't want to miss this webinar this Friday, August 16th, 7 p.m. Eastern Time, 4 p.m. Pacific. I can't wait to see you there. Ultimately, I have a few tricks that I utilize selling puts, and this allows me to get stocks a lot cheaper, and I'm going to show you guys exactly what I'm talking about. You really want to diversify your portfolio. So you don't want to tie up $100,000 capital into one stock. This is not a good idea because you're not diversifying your portfolio enough. So the best thing to do is to pick a couple of different stocks that you're bullish on or that maybe you're neutral on that might be having a little bit of a pullback. This way it gives you the opportunity to sell put and diversify across multiple stocks. So on $100,000, you can retire and make $5,000 to $10,000 a month. I'm going to show you guys exactly how to do this and a little secret tip that I'm going to show you. So stick around on how you can even further print more juicy premium and get stocks at an even greater discount than you thought possible. So what you want to do is sell puts on different stocks in different sectors. We're going to do one financial, two tech and AI, one automotive, and then we'll do one retail, maybe two retail. And I'm going to show you guys exactly how we're going to set this up. So first things first, what we're going to do is with the 100K retirement, look at two retail stocks. So we're going to have retail, and you can set this up really in different ways. It doesn't have to be identical to this. Number one, we're going to look at Wayfair. And then number two, we're going to look at Amazon. For auto, we're going to look at Tesla. And then what we're going to do is for AI and tech, we're going to look at NVIDIA, AMD. We're also going to look at financials, so banks, finances, and we're going to look at Affirm. And then we're also going to look at Square or Block. This right here gives us a nice balance. So I just showed you how to diversify your portfolio. However, to keep things simple for this video, we're really going to look at one or two different stocks because the deltas are going to be somewhat similar. So your monthly income is not going to change if you put 100,000 in one stock or if you put 20,000 into 5 different stocks. It's relatively going to be the same. You obviously want to diversify, but for the purposes of this video, I'm going to show you guys exactly how to set up these puts, the delta to use, and I'm going to show you how to dollar cost average using puts. And this is critical in retirement as it's going to allow you to get shares even cheaper and why puts are more powerful than just buying shares outright. So let's say Tesla is $200 right now, which it is. And then next week it goes up, but then falls down to $197. And then another week, then let's say it goes up a little bit the following week and then falls back for 194. And then it goes up and then falls again the following week and it drops to say 192. The boring stock investor who just buys the stock is going to buy 100 shares at $200. Then he's going to buy another 100 shares when it falls to 197. So 100 at 197. Then when it falls to 194, he's going to buy 100 at 194. And then when it falls to 192, exact same thing, 100 by 192. What is the average price? Well, I can show you guys exactly what that would be. 100 at $200, another 100 at 197, another at 194, and another 100 at 192. 400 shares with an average price of 195.75. Average price 195.75. Okay, same exact formula, except we sell a $200 put. $200 put. We're going to collect premium on this. We're going to go out a week. We're going to collect $530. Let's say we get assigned. Now we have 100 shares at 200, same as the stockholder. Then we sell 197.50 put, which is $425 roughly. $425. Then the stock falls below, we get assigned. So we pay $197.50 times 100 shares. Now the stock is going to fall yet again, so we're going to sell a 195 put. And this is going to get us about 340. And we are going to get assigned at 195. So we're getting 195 shares times 100. But then the price is going to go up. We're feeling like it's going to drop. So we're going to sell a 192.50 put. 192.50 put. And this is going to collect us 270. So we're going to collect 270 from this. And we're going to collect 100 shares at 192.50. So now we're going to average this out the same way we did on the other one. 100 shares at 200, 100 shares at 197.50, another 100 shares at 195, then 192.50, giving us an average price of 196.25. So the average price here is 196.25. So we are only behind the shareholder by 50 cents a share at 400 shares. So 50 cents a share times 400 shares, we're only out $200 in comparison to the simple shareholder. However, we collected $530 on the first put, then $425 on the second put, then $340 on the third put, then $270 on the last put. Therefore, we are $1,365 in the positive in comparison to the shareholder. Now, if you take into account this amount of money off of the average cost, we're going to do 400 shares times 196.25. We've spent 78,500. Take away 1365 is 77,135 divided by 400, giving us an average price of 192.83. Let's do 192.84. So after we take into account the premiums, 192.84. What we have done is every single share, we are almost $4 in the positive. So we have actually lowered our average cost from 195.75, which is dollar cost averaging. But when we do it with puts, my simple little hyper theta strategy that I have in my training course, which is why you guys don't want to miss the webinar. This is just one of the many tips and tricks and strategies that I use in my hyper theta strategy, which is why everybody in my Discord is printing money every single week, because I have strategies that beat the market that allow you to make a little extra and a little more consistently, and that adds up over time. Taking a little more and a little extra and doing that consistently prints juicy premiums every single week. So you guys don't want to miss my webinar this Friday, August 16th, 7 p.m. Eastern time, 4 p.m. Pacific. You guys do not want to miss out, because I'm going to do an in-depth webinar on selling puts, this exact strategy, more advanced than the technicals, fundamentals, financials. You guys don't want to miss that. So 192.84. 195.75 take away 192.84. $2.91 less per share is what we've paid. This is why selling puts the dollar cost average is absolutely awesome. All right, So keep in mind that we were going off of different prices on the puts. I was using what was actually in the options chain. However, if we were to sell a 197.50, if the stock had dropped to 200, which is a little lower than it is now, this would be a little bit higher. Then once we get assigned on that, if we were to sell a 195, but the price had fallen below 197, this wouldn't be 340, be closer to 400 or 500. So it's safe to say that we'd be making about 400 to 500 every single week, which is about $2,000 a month, which is really, really good because this is on $20,000. So now let's really take a look. Now that we've learned how to dollar cost average, we actually would have a lower cost than 192.84, but this ultimately is a safe number because as the price drops, we're selling puts at the money, which means they're a lot better than say this 340 or 270. So realistically, we'd be looking about another $500 more here. So instead of 1365, closer to 2000, which means our dollar cost average will be more or less 190, give or take. But this is confusing things, so I'm going to keep it simple. Let's take a look and see how much money we could make on Tesla just selling puts. So we're looking at these puts right now. Tesla's at 200. We want to be a little bit safer, so we would sell 195 puts or 192.50. But let's say 195. We could probably get 350 for this contract. And we could sell 6 contracts would get us about $2,100 per week, just a little bit less, but about $2,100, which is about $8,000 a month. So you figure if we were to get $2,100 and we times that by 4, we're looking at $8,400. This is a delta of 32, which is pretty decently. It's a little bit aggressive, but since we are doing cash secured puts, we can't go wrong. And I showed you guys how to dollar cost average. So let's say the price comes down, you sell another put at the money. We're still going to make $8,000 this month, but then all of our capital is going to be in Tesla. So what do we do then? Well, it's quite simple. Showing you guys we can make $8,400 in 1 month. Now we have 400 shares of Tesla. Now what? Well, if Tesla's at $190, $192, $193, we can now sell $195 or $197 calls, because remember, our dollar cost average is going to be around 190 to 192 worst case scenario if we get assigned on all of these shares. So what we're going to do is we're going to go up 2 legs, which is 500 above the price right now, and we're just going to go off of that. So we're going to go ahead and sell 6 contracts. We'll get about 460 for this. We'll make $2,700 every week. So let's say 2760 times 4, so 11,000. So month 1, 8,400, month 2, 11,000, plus we're also going to make 400 shares times $5, so 13,000 plus the 8,400 in the first month. So on this retirement plan, we're about 11,000 a month, 10 to 11,000 a month. So let's recap. We sell a put on Tesla at 200, it drops to 197. We sell a 197.50 put, it drops to 195. We sell a 195, then it drops. We sell a 192.50, it drops to 191. We now have 400 shares, and we wait for it to consolidate and come back up. But while we're waiting, we sell $197 calls since our average cost is 190 to 192, and we make another $2,700 a week selling those calls. And once we get assigned, we make a total of $11,000 in covered calls for the month plus the assignment. If we get assigned on the first week, well, then that would mean that we made $2,760 plus 400 times 5, $4,760 plus 8,400. We're 5 weeks in and have $13,000. You can see that this is going to kind of normalize throughout the year. No matter how you really calculate it, it's really ultimately going to come back to 5 to 10 grand a month, because my strategy consistently makes 5 to 10% per month. So even at worst case, you are making about $8,000 a month times 12, your 100,000 generates $96,000. You're talking about a 60 to 100% return on $100,000, making retirement very doable. This is what makes this strategy so very powerful. You can sell puts, dollar cost average, and by using puts to dollar cost average, you significantly reduce your average cost even more than the stock investor, the boring old stock investor. And by doing this, you can then turn around and sell covered calls. And if it takes 2 months to get out, well, then you're generating $8,000 to $10,000 a month in covered calls. And when you exit, you're taking a big premium and a big profit with you. So you guys can see how you can retire on as little as $100,000. Just giving you an example on Tesla alone. This is a very powerful strategy. If you guys are interested in learning more, I am hosting a free webinar this Friday, August 16th, 7 p.m. Eastern, 4 p.m. Pacific. Register now. The link is in the information box below. Limited spots available. We're filling up quick, and once it's full, there will be no more availability. So sign up as soon as you can right now if you're interested. I have a huge announcement during this webinar, and I will also have a Q&A section, time dedicated for you to ask me questions. You guys are going to have a lot of fun, and you're going to learn a lot of technicals, fundamentals, financials, charting, running analysis on stocks, and how to enter, and a lot more detail than what I provided you guys here in this video today, as I'm limited on time. If you guys are interested, like I said, the link's in the information box below, and I hope to see you there. This video's over, but don't worry, guys. I picked out another video just for you, and you're going to love it. That video is right here. Click that video. I'll see you guys over there. And remember, until the next video, let's grow our wealth together. Take care, guys.